$6.1 billion,
Yeah.
the largest multi-family office in India, managing
Yeah.
1400 plus ultra HNIs.
So the clients that we work for would be less than 0.5% of India. These are businesses which are anywhere between a turnover of say 500 crores to 5,000 crores.
Your clients are roughly 39% family offices,
Yeah.
33% CXOs, 25% entrepreneurs, and 3% trust. What are the common mistakes you see people in their early life making when it comes to wealth creation?
The younger generation, especially post-COVID, largely I think they've gravitated towards trading platforms. This isn't a great sign. I don't even have a demat account because
What's the single biggest differentiator you see how these ultra HNIs spend money versus middle class?
their relationship with wealth is very similar to.
Welcome to the Nuance Show, Rohit. Very excited to be hosting you today.
Thank you very much.
So you guys started in 2002.
That's right.
And the firm Client Associates now manage over $1.6 billion.
6.1, I would say.
$6.1 billion.
Yeah.
Wow. From over 1,400
Unique
family
families.
offices.
Yeah, that's right.
So when you meet someone new, how do you explain what you do?
So I think if I can coin it in one single sentence, it's like that we are family CFOs. Just like CFO at the corporate level would help the business manage the corporate balance sheet or the corporate wealth and solve any problems around the balance sheet of the business, we would do the same thing around personal wealth or family wealth, trying to help families solve any problem which they may have around their family's wealth. So that is what we do, and we work as a multi-family office. In fact, when we started in 2002, we pioneered the concept by launching ourselves as India's first multi-family office. Those were really early days because Mr. Premji and I remember this very distinctly, was the first Indian to set up his own family office in 2006, which was 4 years after we started and introduced the concept in India.
So what happened in the early years? Like you set up the shop in 2002. How did you identify the next first 5 customers, your pitch to them, how they, took the idea?
I think the first year was a very interesting year because suddenly I think we, as founders of a new venture, bootstrapped, grown up in middle class homes, deciding to quit our multinational jobs, which were a huge privilege in the society at that point in time. And from a full salary to a no salary, coming into that, it was a massive shift. And I remember when I started, I had a negative net worth at that point in time of 32 lakhs, and which now you can do inflation adjusted. So no salary, negative net worth of 32 lakhs. But then we had done our financial planning, because if we were getting into wealth management, then we pretty much, should know about our own financial planning. So we had done our financial planning, which can, keep us afloat for next 12 months. And we decided we will not take any salary in the first year, because rather we focus on building revenue instead of building cost. But I think we got a good response. We had a go-to market because we had been in the industry. We had our own network to go to. So we started going to them with a proposition of family office. It was a new proposition. It was a very client-centric proposition, which made a lot of sense to customers.
What type of family business these were, and what was the scale, if you can just give me some idea?
Yeah, so see, the economy and the markets were of a different scale at that point in time. And I remember that we had kept a client qualification threshold. At that time, $1 million used to be 2 CR. And we had kept that because that time Merrill Lynch also used to be there as one of the wealth managers, non-banking, and they used to have that threshold. And we said that we will keep the same bar for ourselves also. So $1 million has always been the threshold for our industry globally. We started off with that, which used to be 2 CR. At that point in time, the wealth largely used to be embedded with the generational business families, where it was, and then there were some professionals, which are senior corporate executives, which started coming into wealth. So entrepreneurship had just started developing. So it was largely 2 buckets, 2 segments. It is the families in business, and secondly is the corporate professionals, which was a go-to market.
So I think Today, your clients are roughly 39% family offices,
Yeah.
33% CXOs, 25% entrepreneurs, and 3% trust. How was this split then?
So largely, I would say that point in time, this would be about 60% would be family in business, because that is where the source of the wealth was actually sitting.
Yeah.
That point in time in the society. These could be from small businesses like exporters to mid-sized businesses into manufacturing. Then the rest, about 40 odd percent, could be senior corporate executives and professionals. But then over a period of time, as the entrepreneurship bug hit the Indian society, and that is where the third segment emerged, which is the new wealth segment, which is through entrepreneurship, where the first generation entrepreneurs, they created ventures and they then unlocked wealth, monetized wealth through their ventures. So over a period of time, there's the second, rather the third bucket, which emerged over a period of time.
There is one stat there that says that India now has some 308 billionaires. And if you
Yeah.
can share the number of millionaires, like what's that number and how you see that number evolving over the last few years?
Yes, millionaires, typically a dollar millionaire is about, which in today's time will be about 9.5 crores. I think there are various sources, but whatever number ballpark which comes around is about a million odd households. There are about a million odd millionaires, dollar millionaires in India. And I think that figure is growing. When we started, it used to be in thousands. That point in time, which has gone to a billion now. So I think the affluence is spreading in the society, but this million households still are just a dot in the ocean of India's market. They just constitute about 0.3, 0.4% of India's overall number of households. So the clients that we work for would be clearly are less than 0.5% of India. But then this will continue to grow over a period of time as more and more people come into money and they unlock wealth. As the affluence, the wealth effect will create more wealth for more and more people in the society. So I expect that this number will inch upwards from the current very small dot which is there.
So how are now people making money or creating wealth?
So now I think it is happening across the board. This is what happens when an economy grows. When an economy grows, then wealth creates wealth. Because what is the law of economics is that one person's expense is another person's income. Right? So when one person creates wealth, then one person also spends a part of it. And even that part which the person is not spending, this person is investing. That also creates economics for, creates an industry for banking and financial services. To answer your question, where wealth is happening is today, I think the wealth in India is being driven by Indian society's increasing ability to consume more and more. Like 60% of India's GDP is driven by consumption, and about 40% is by investment.
Yeah.
And who are the people in India who created wealth? People, there are two. Their consumer businesses, number one, whether they are traditional consumer businesses, or their consumer internet businesses, which have scaled because driven by consumption. And the second is investment, which is let us say, which is businesses which are driven into infrastructure and all, highways, ports, airports, and so on and so forth, because that's is also given scale. So I think that is where wealth creation is happening in India. Largely, consumption of India is driving wealth creation, and which is benefiting now multiple industries. And there is another interesting data point which I can share with you is that now India's per capita income is roughly about 3,000 plus minus, US dollars. So typically, see, when in countries, and this has been seen in the Southeast Asia and Asian economies like China and all in the past, that whenever a country's per capita income has crossed $2,000, that economy, that's the inflection point for the economy. Because what happens is still $2,000 per person, that society is in a survival mode. Whatever you're earning, you are just kind of surviving. There is no surplus income left for other discretionary activities. You're just spending on non-discretionary, which are essential things to consume, right? So India has now crossed that threshold about 5, 6, 7, 8 years back. And when that happens, so this additional now today $1,000 per person, per year, is then propelling India's consumption story, because then that $1,000 per person per year is actually creating demand for multiple products and industries, right? It could be HI, it could be travel and tourism, and which will lead to wealth creation. So basically, wealth is creating wealth, So that's a dynamo effect which is coming already in, has started, will only increase with times to come.
And let's also talk about the traditional family offices, how they
Yeah.
have been, managing their wealth within your portfolio, outside your portfolio. If you see any trend, they are just compounding their wealth or venturing into different ventures, or maybe third or fourth generation that is not able to keep up with the
Yeah.
wealth that first generation or second generation made.
So, see, in case of family businesses, they are not new to managing their wealth because they've been in wealth across multiple generations. It's just that their perspective around how to manage wealth keeps changing with changing times, and more essentially with two things, which is with the fresh perspective of the younger generation which they bring in after they've completed their education, they've seen the world and come back to family, and also the readiness of the older generation to let the reins go, right? So also openness to accept those new ideas. But by and large, despite this, largely their approach to wealth management remains glued to protecting their core family values, right? So while they're happy to continue to upgrade their skills, freshen their perspective and stuff like that, be in sync with the latest times, but not at the expense of the core family values. So that is, every senior generation is very conscious that they would want to pass on as a baton to the next generation. So they're happy to give more freedom to the new generation to bring in fresh ideas, but provided the good old core family values are protected. So I think there for them, since they've been in wealth for a long period of time across generations, one of the core values is to protection of wealth, right? Because for them, it is not to get rich, but to stay rich, right? So protection of wealth is not that they don't want to grow their wealth, but their expectation is not that they have to compound their wealth at 20% per annum. Even if they can compound their wealth about 10-12%, they're absolutely fine with it, right? So because it really doesn't affect. The larger goal is that the family wealth is like a family legacy, and it is a generational wealth, which means the scale of that wealth is so large that it will last beyond the lifetime of the existing generation. Then the primary goal of such a family becomes to really compound this wealth across generations, right? So then protection balanced with growth becomes a strategy. So that is what the key difference is.
But can you share some examples where you saw that maybe the older generation is a bit hesitant passing down the wealth to the newer generation because maybe the knowledge that the newer generation has accumulated, the older generation is not able to understand? Or let's say AI, we see a lot of family offices, the second or third generation, they are very excited about AI, and the older
Yeah.
generation is not able to understand, or maybe wants to take some more time to understand what it actually is. And the newer generation, maybe they want to ride the AI wave now only. So any anecdote story you want to share?
Yeah. So I think you brought in a very interesting aspect. So I think I see less and less of this conflict between the older and the younger generation now than what I used to see maybe 20 years back.
Okay.
And I guess one reason for that would be that the tech shift, which has happened dramatically, you know, maybe in the last 15, 20 years, especially after the smartphone era, which is what I think, which has created the gap in the understanding of opportunities between the older generation and the newer generation, because the newer generation is grown up in the internet era. So they are more familiar with the opportunities which are coming. First, the internet came, then the smartphone came. Now AI has come. So I think the older generation understands that the arbitrage between their understanding and the next generation understanding is now really widened. So that is where they are now a lot more flexible and open-minded to let the younger generation make the lead. And this is also getting validated. In fact, today, when you see there's one report of PwC which came out in 2024, which said that in India there are about 300 family offices. Now, if you pick up, bulk of the list of family offices, largely they are being steered by the younger generation. I can mention a few names because they are publicly available. They are not private. For example, the Marico family. The next generation is actually leading the family office, while the father really built a very respectable brand over the generation. That's a public name which I can quote out, and there's several other names which I get to see. These are businesses which could be anywhere between a turnover of say 500 crores to 5,000 crores. Many of them could be unlisted, privately held, but it is the younger generation, which is taking the charge to kind of steer the family wealth, and the senior generation is very, very happy to be guided by them. So this is clearly happening. Coming to AI, see, yes, AI is a trend, but as of now, I see what the excitement around AI is not very different than what it used to be when it was dotcom era, and I've seen it up and close. The first opportunity to start a venture came to us was to basically create a dotcom around wealth management. And so much of capital which was available to just start your dotcom, because ideas were getting funded on the basis of only eyeballs, and which was very unrealistic. Because see, what is a business at the end of the day is something which creates cash flows, and eyeballs don't convert into cash flows. It was some belief that so many users are coming and eventually you'll be able to monetize them. But how do you monetize them? By solving a problem for users. By just attracting users to come and see you, you're not solving any problem, right? So thankfully, we did not participate in that opportunity, because, and then we all know it's all history. Dotcom went through a bust. Only a few of them were really survived. Amazon is one of them. The rest all went down. So I think something similar is happening around AI as well. And this happens. It has happened in many times. If you pick up the human history, it has happened many, many times that whenever a new change comes in the society, it really attracts masses, that now the world is really going to change, and I don't want to miss the bus. I want to be part of this change. So it will attract a disproportionate amount of attention of the society. It could be in terms of eyeballs. It could be actually in terms of capital. So a disproportionate amount of capital gets allocated towards a new trend. But then, when the filtration happens, when things settle down, then only the serious long-term players, they are the ones who survive. And the rest, really, they get filtered out. I think same thing is going to happen around AI as well. Like, you must be kind of an observer of the AI pattern as is happening in the US. About more than $750 billion has been invested in that. And essentially, it has been done by the largest tech firms, and it's been mutual investments happening between them, because somehow they're driven by their kind of desire to dominate a world which will be driven by AI, right? So that they are dominating the ecosystem. But eventually, the world is yet to see the fruits of it, right? So bubbles get created all the time whenever a new trend or a new thing comes up. But then the bubble do burst also, and then the reality and the life carries on based on realistic pattern.
So you think for now we are in the bubble and dust will settle in some
Yeah,
time?
because see, where have we seen actual implementation of AI? Right? So nobody has really seen the validation of the technology till now. Technologies surely is going to stay. It is going to be part of our lives. Like internet came, smartphones came. It is going to be an enabler. But I think over-investment is happening in that space at this point in time. Over a period of time when AI has now started getting into the enterprise space. For example, OpenAI and Anthropic, they have done collaborations with our own companies, Infosys and TCS. Why they have done collaboration? Because they have created solutions which need to be implemented at the enterprise level, where they need the help of these companies, because they are the service providers to enterprises. When that implementation will happen, which my guess is over the next 12 to 18 months, we'll start seeing the earliest signs about the validation of the efficacy of that, right? What ROI one is going to
But then
generate.
isn't now the right time to invest if the next 12 months are, like you said, that Amazon survived?
Yeah.
So there will be some companies who would survive and would become as large as Amazon.
While if you have the wisdom or a magic wand to know which who's going to be the Amazon of this pattern, then the answer is yes. But it's very hard to do that, because even in 2000 nobody would have thought
Yeah.
that Amazon will be what it is today. So I think in times like this, it's just the idea is to just sit by the sideline, be a witness rather than being an actor. Enjoy the drama, take away your learnings from it, and based on those learnings, when the dust is settled down, then make your move. There is no point, just joining the herd and the noise and then going down with everybody.
So what are you advising to family offices where younger generation has also joined the business, but older generation is still participating, and this generation wants to participate in AI? So how do you then advise?
So see, so our advice to them is just wait and watch, because it's very, very early days. Because see, any technology we have seen is very binary. Either it works or it doesn't work. So while the rewards can be disproportionately high if it works, the risk are also could be disproportionately high if it doesn't work. So it's 0 and 1.
Yeah.
So if you have the risk appetite to be 0 and you're prepared to take that risk to be the 1, you please participate, because it can be a jackpot. But if you do not have the risk appetite, then just as I mentioned, be an observer on the sideline, learn about these things. And AI is going to remain for next, decades. So you'll have n number of opportunities to participate in that. Amazon also didn't become an Amazon overnight after .com, right?
Yeah.
So we will get our chance to pick and choose, more rationally when things have really started becoming more clearer. So that is what our advice to family offices.
So at Client Associates, you guys are for now not participating in AI.
Not participating, because I think it's very hazy at this point in time.
And Rohit, you work with some 1400 ultra HNIs. How these guys structure their wealth different than rest of us, and which asset classes they structure their wealth in most common?
So in the past, the traditional asset classes have been listed equities and bonds. When we started, the most popular instrument at that point in time used to be RBI bonds. The RBI used to issue tax-free bonds.
Yeah.
And I've seen times where RBI has been giving 9 to 10% post-tax return, tax-free return. Very, very popular.
Yeah.
Because our inflation also used to be pretty high at that point in time. So, but then over a period of time, clients, they became familiar with equity as an asset class. They understood the power of equities to compound over a long period of time.
When did you see this trend in India, like the interest for equity?
I think you've seen this strengthen more so in the last 10 years. But then it has started creeping in the 2000 onwards. Before 2000, it was a market which was very opportunistic, very trading oriented, based on everybody used to look for a tip, because that's the only way to make money from equities. But then later on, I think when people started participating in it in an organized manner, in a long-term approach in 2000s, and then they experienced the markets going down during the global financial crisis and then coming up and so on. So, when investors have gone through different market cycles, they've understood the asset class. And that's the reason they've understood that this is the nature of the asset class. And the best way to benefit from the benefit of this asset class is to stay in the game. Right? So, another asset class traditionally where a lot of Indians historically and still are remain invested in real estate. Because the growth in real estate is what they had experienced, because they've seen, and real estate, they've not seen going down because there's no mark-to-market value which comes on a daily basis. Plus equities they had not experienced apart from just in a very opportunistic way. Now, over a period of time, they've seen that real estate, of course, in the last 5, 6 years, the cycle has come back, but there was a large down cycle between 2012 and 2020. And equities were actually doing well during point in time. So they've understood that over a long period of time, real estate will compound higher than real estate. So they continue to invest in real estate, but then they are also now comfortable to diversify beyond bonds are not available anymore, real estate into equities also. And now Indians are, these families also looking to diversify beyond India
Yeah.
because that maturity has also come that, especially in the recent times, we have seen the rupee's depreciation against the USD. So they've understood the importance of diversifying beyond India. So I think the horizon is really, really expanding as the Indian investor is getting more and more experienced.
Mm, uh, can you please explain this point? Why Indian family offices are diversifying beyond India, and what are the key reasons, and how do you see this panning out in the next 10 years?
See, the reason is that if you are, it's like good old, adage of don't keep all your eggs in one basket. So if you're invested fully only in India, yes, given that India is the fastest growing large economy and stuff like that, they'll continue to grow. But then it is also important to diversify from the point of view of not maximizing your wealth, but also bringing in as a cushion into your portfolio. When you invest outside India in a global portfolio, which is poorly correlated with the Indian markets, so then you are basically bringing in the benefits of diversification into your portfolio. It is not maximizing your wealth, right? But it is making your portfolio more stable, right? Instead of it going like this, maybe it is going like this. So that sine curve, is becoming more, stable, instead of more spiky. So I think that is the real benefit of investing outside India, because you are able to participate in the pockets of growth which is there globally. Also, you are able to diversify across currency, because in India your exposure is only in rupee.
Yeah. And then what's the single biggest differentiator you see how these ultra HNI spend money versus middle class, let's say?
A very interesting question. Thank you for asking it. And I have seen this and up and flows. I've been a student of wealth all my life. And see, ultra HNI families, see, they have gone through that phase. They're also humans, but they've been through that learning curve. So they largely spend their money on their needs and not wants. Whereas people who are just getting there, they're getting into affluence, they're the first time they brush and they want to really express their aspiration
Celebrate the money they have just
by on their wants, right? So because it's the first time for them, and they'll also get over that and eventually. So I would say the question that you asked is how's their relationship with wealth.
Yes.
So I would say that their relationship with wealth is very similar to like that of a mature partner who respects you, right, understands you, and takes your help only when needed, right? So pretty much like that I have wealth and wealth is an enabler. Of course, I live a good life and I will leverage my wealth as a friend to live a good life for my needs and not splurge on my wants, which doesn't matter to me much. But what matter to me is what my needs are. So I think that is what the relationship with wealth is, which is quite nice.
We have talked about family offices enough. Let's just talk about the founders who have, let's say, just made their money. And if a founder is building in India and building for the world, US or European market, how should they structure their wealth?
Yeah, so I think have a balanced approach between setting your goals for wealth is between growth and protection. While the first generation wealth owners are more skewed towards growth because they are driven by growth, because that's what have got them here.
Yeah. You need to be patient with your money.
Patient with your money, and we have seen a number of examples, and I can name it because it's in public domain. Byju's, they created such a nice scale business and a brand, but what happened, right? So So I think it has to be a balanced approach where you balance your aspirations for growth with protection, right? If you just make it very skewed only on the growth side or only on the protection side, then your outcomes over a long term may be very, very suboptimal. If you're skewed only in favor of protection, then the opportunity cost of compounding at even a balanced growth rate of 10-12% could be very high over a 30-year scenario. But if you are compounding only skewed on the favor of growth, then maybe the additional disproportionate risk that you've taken might actually could have eroded your wealth.
So the risk that you have taken to scale your business, you don't have to do the same
Yeah.
thing with wealth creation. You need to be more
Absolutely.
patient.
Yeah, that's right. Need to be more patient, and uh, I think wealth stays with them who are patient. It's a gift, which is given by people who are impatient to those people who are patient.
You and Imanshu started this journey in 2002. When you started, you obviously had a goal in mind. Now, after all these years, what do you think? Why this, like what this journey means now, looking back? What all happened? How do you reflect on this journey?
So first, coming to your first part of the question is that, was that the right time to start? Then I said the answer is yes, because see, we really had a very, very early mover advantage in various ways that, we were able to bring a concept to the market, which
Was
we were the
foreign,
pioneers.
yeah.
People heard that concept from us first, and then we kind of virtually had the freedom to create a market around it. So no competition virtually at that point in time when you start very early. Of course, we also took the risk of that concept not being accepted by the market. We could have failed also, but then there's no reward without any risk. So we had a massive first mover advantage, and then the other advantage which comes is that you've got talent which is available, maybe at a fraction of a cost which is available today. So your entry barrier was very, very, I would say benign at that point in time, that we could actually be in business on our own. We just picked up a computer which was being auctioned by Deutsche Bank, the older computer, and I still remember that we won one computer for 8,000 rupees. It was a desktop that point in time, and that was a machine to be in business. So it was as small an entry barrier as that, at that point in time. And of course, our own personal lifestyle cost was still manageable. Then the cost of starting this business, which has become now. So I think that was the advantage. I think that was, I would say, looking back, that was the right time to start. What we could have done differently and what not differently, I would say, first of all, we built this business organically, bootstrapped. So I think that is something which we would like to repeat if I would like to start client associates today. And I tell you the reason for that. Because see, this is a business which is in the business of perpetual service. Wealth has to be looked after forever, across generation. And that's, to be able to do that, you need to build credibility, which will lead to trust. Then only that stickiness is there and that compounding will happen. If you do this transactionally, then this one customer is coming, then is going away, then you're replacing this with a new customer, that compounding never happens. And I think because of the nature of the business, it is very important that you do this business keeping client at the center, doing the right things for the client. And that is possible only if you have the independence to do it, right? So let us say if you have an organization which was led by managers, then naturally it's not that they don't do a good job, but then they are also driven by their own career aspirations, and they are in a typically role. If somebody is bright, maybe a few years, and then it is going all the way down. So everybody, then I say, when we ask to working with the bank, is typically everybody's focused on their goals than the customer goals. So you're not able to really pay attention to the customer fully. Then there are organization and industry which are investor led, and then naturally the objective of investors are very different, because their objective is that they have to make money for their LPs, and they have to multiply the business and then find an exit in a few years. It's only in an owner driven organic setup like ours you have the independence to do the right thing for the business. And for the business, when I say, it's for two stakeholders, right things for two stakeholders. One is the customer, and second is people who take care of the customers. So clients and associates, that's where our name comes from. That our business is nothing else but these two pillars. Then other functions, research is a very important core of our business. So these are basically the engines of our business. That is what I
What
mean.
happens in research part?
So research part, Nancy. I understood that this very early, that this is the core of our business. This is, I can say, not only just the mind but also the heart of our business, because we are in knowledge business. And if we have to truly work like a family office, then we really, really need to have our own independent research, which is a buy-side research. A buy-side research is a family office produces for taking its own decisions, which helps you to form your own independent view. Because a sell-side research will always be bullish. When times are good, it'll be bullish. They have good reasons to say it's why they're bullish. When times are not so good, they'll have good reasons to say why they're bullish. Because it is then aligned with the sell-side goal. So what we as a research, we produce is that we, first of all, access our own data directly from the sources, whether it's Bloomberg, Morningstar, Value Research, whatever. Then we process that and come out with the output, based upon the models that we have built. Because, see, in investing, it is not, you don't should look at the hindsight, but you have to have an advice which is forward-looking. Because markets are constantly discounting an emerging future. So there is no point going and advising clients based on the narrative which is already played out.
And wealth management is was a foreign concept. So if you have to draw parallels, how Indian family offices are doing versus their Western counterparts in terms of wealth accumulation, behavior,
Yeah. No, I'm very
forward-looking thinking.
very glad that why we might have pioneered it, but we did it in this case. Otherwise, somebody else would have did it. Nobody can stop an idea whose time has come, right? But I'm very glad that it's as a concept, it has got picked up by the Indian society, because see, a family office is what came up. It started with the Rockefeller family. They were the one who first introduced the concept of family office in the US. Started with their goal to manage their family wealth, and when they kind of mastered the art, then they started offering it to other wealthy families. And then in the European continent, there are examples of the Rothschild family, which is also a generationally wealthy family, and they've also kind of demonstrated a capability. So all this in the Western developed world, the concept of family offices flourished. And I wouldn't be wrong to say that in the US, there'll be thousands of family offices, because the scale of wealth is humongous and the spread of wealth is also very, very broad. And so would be the case in continental Europe, because their wealth essentially came from the colonial wealth, which is much longer even in the US, American wealth. And I think Indian families are quickly learning about it, because they've understood because their younger generation has gone out for their education, they've got the exposure, and they've learned that this is nothing else but family office is nothing else but it's an institutionalization of management of family legacy, right? And this is what has helped the West to preserve their wealth, and this is what they've understood is important for them, for us also to preserve our wealth. We used to be the richest country some 300 years back, right? That's the reason we invited external invaders to our country who took away our peacock throne and Kohinoor.
Yeah.
I think that same wealth will come back to India next 50 years, right? So, but only if we as a society learn to take care of it.
Take care of it.
So,
and Client Associates is the largest multi-family office in India, managing 1400 plus ultra HNIs. But I'm sure we would have a lot of newer wealth advisors also coming to the entry, but the number is very low. So why the barrier to entry is so, it's just so difficult to get into this industry?
So if you look at, there are, our industry is also today really, really, breadth is a lot, but there is a confusion of nomenclature in industry. So there are, one set of players which are called mutual fund distributors. They're also, helping their clients to kind of compound their wealth in their own way. But one section of the industry which is calls themselves advisors because they've taken a SEBI license like RA. We are also incidentally one of them, and they believe they are the only ones who are advising, and they are just about less than 500 odd which are active. But the reason for that, why the number of registered investment advisors are very, very less, is because see the market readiness. And this is not only an Indian phenomenon, but the global phenomenon as well. It's a classic consumer psychology that when it comes to writing a check for paying for services, the customer is not ready for it. So I think that concept, because of that reason, is really not taken off. But when you look at the mutual fund distributors, there are lakhs and lakhs of them. And every nook and corner of the country, it could be not only in forget tier 1 cities, they'll be in tier 3 cities. And which is what actually is, that's a force which is actually driving the financialization of savings in India, which is getting manifested in the amount of money which is coming into SIPs. Last month was some 32,000 crores. So I think, but if your question is around building wealth management platforms, why the entry barriers are high, and reason for that is, as an industry, we have come a long way, some 25 years odd, because I seriously believe that this industry started coming into its, started building beginning of 2000. So when I came into ANZ Grindlays, that bank, I was hired by ANZ Grindlays Bank as team of the 10 people to launch wealth business in India, way back in beginning 99. So I can call myself the first generation of wealth management in India. So about 25 years, industry has really, really come a long way. So what has happened there is, while the industry has really grown in terms of the size of the pie, but the cost structure of the industry has also grown. And that is, the real cost structure is centered around the people. It's a people's business. It's a service business.
Yeah.
So naturally, because so many people entering, they've kind of, the talent is limited and the cost of talent has gone up. So today, actually, for somebody who's starting this business, the economics are not very favorable.
Now let's talk about your book, Unlocking Wealth. You talked about it focuses a lot on building wealth early. So if you can share more about that, like why did you focus a lot on this topic in your book?
Yeah, no, thanks for asking that, because see, I'll tell you, the core of writing this book was because, see, thankfully, I'm in a profession where I'm able to get to see data about the potential of India to create wealth, which I guess all my fellow Indians do not have the advantage to see that data. And I think that this century will going to be India's century. That's a fact which is very, very uncontested and largely should happen.
Why do you say that? If you can just share some data points.
Yeah, because see, India today is the fastest growing large economy. So the maximum compounding effect is going to come because of two things. A, your scale, and second, at what rate you're growing that. So if you multiply the two, then in absolute terms, your compounding will happen maximum there, right? So this is there in case of India. So I gave you an example of the per capita GDP. So we're already at 3,000. Over about 20 years, I think there's a good chance that we should get to about 15,000 or so. And that is where we will get categorized as a mid-market, affluent nation from a poor nation currently. So I think within this century, which belongs to India, I think next 10 years could be India's best years, because after that also India will keep compounding and keep growing. But I think your base effect will start catching up with you as it is catching up with China now. So I wanted basically awareness of that to come to every Indian, right? Because especially in a country where the average age of every Indian is 29 years, right? We are still very young. And compared to China, that's about 38, 39 years. In case of Pakistan, it's about 23 years. So 65% of the population is below 35 years of age. So we are a very, very young country. If I go to public places, I hardly see people of my age group, right? It's a very, very young country. And I want every young Indian to know that, next 10 years is going to be perhaps India's best years in the entire century. So they should and must start early, because that is how they will benefit from the benefit of compounding, right? So they will bring into their lives an atomic habit of saving. So today, if they are saving 100, tomorrow they'll be able to save 1,000 and then 100,000, because they'll keep growing in life. So they will become perpetual wealth creators, right? And then not only they will become wealthy, but they'll also kind of amplify the wealth effect in the entire country, because wealth is what creates wealth. So I think that is what the central motivation of writing this book was, that this message, and the book was written in a very, very accessible language. It's not written for economists because they know it all or they don't know it all. It was written for every Indian, who should know that what times you are living in.
What are the common mistakes you see people in their early life making when it comes to wealth creation, saving, or investment?
Yeah, the common mistake is that they become late savers. Or I would say late investors, because savers are the one who basically keep their money in a
Hold
savings
it.
account.
Yeah.
That's where the name savings account comes from. It's largely liquidity. But they become late investors because they keep thinking that abhi to hamare paas hai hi nahi. So let me come into money, some surpluses, some meaningful, I'll start investing. I would say that you should start becoming an investor right from the first paycheck.
How smart they are, what data says when it comes to investing early, the younger
See,
generation.
the younger generation, especially post COVID, largely I think they've gravitated towards trading platforms. And
Which isn't a great sign.
this isn't a great sign, because see, a trading platform, in trading, it's only the platform which makes money. Most traders don't make money, right? So it's like in gambling, the house is always in the money, because it's always taking, a fraction of using a toll or a user charge for using the platform, right? So trading basically creates short-term profits. Investing is what creates long-term wealth creation. And my own personal experience and belief is that trading is a zero-sum game. And I'll share my own personal example. See, way back when I used to work with a bank as a very young kid, I was very excited and opened a demat account. And those were the days beginning 2000 tips and all that. I thought, I'm in this business. I'm a smart guy with access and I know much more than everybody. So my own experience was that, yes, if I've done 10 trades, 7 out of 10 were I made money. But then those 3 where I lost money, the cumulative loss on those 3 was higher than the cumulative gains on those 7. Right? So you don't realize that, because once you're making successful trades, you keep on committing more and more. But then you don't know that one hit because of one loss can actually wipe out all your gains. So eventually trading doesn't make you money. And that's the reason I think somewhere last year, SEBI also shared data that in derivatives, about 90% of Indians are losing money, right? Institutions are making profits at their expense. So I think the younger generation in India, they should move away or graduate from trading to investing, because that is where they will they will create wealth. And the basic habit and atomic habit of investing is accumulation. So right from your first paycheck, pay yourself whatever amount it may be, doesn't matter.
There's lack of awareness, or there is lack of patience.
I would say lack of awareness. Patience will come if awareness is there, because if you know or I know that by remaining patient it is in my benefit, why will I or anybody will not be patient? So I think lack of awareness, because financial literacy is very, very limited in our country. It is not taught in schools.
Yeah. Is it ever too late when it comes to investing, wealth creation, that if somebody is in their 50s, 60s, they feel that there are certain things they missed out on?
So I would say that anybody who's got at least a 10-year cycle to invest, it's never too late. And especially now in a society when we are seeing that the society is living longer, don't we see the senior generation, our parents, their friends, they're touching 90. 60, you still have a 30-year time horizon as per that markup, and it's a long way. Let's talk of Warren Buffett. He's in his late 90s and he's become Warren Buffett because 70 years of compounding. He started
Yeah.
investing when he was 21 years old.
I'll close our conversation with a rapid fire. The best investment you have ever made.
I guess client resources would be the best investment, but jokes apart, I think traveling is the best investment because not just me, our family loves traveling because we see traveling as not as a leisure activity, but as a source of education. That is what really helps you to get to see the real world, what's happening. It opens your eyes.
Yeah.
So I think that is the best investment.
The book you gift most often.
So it's a very nice Japanese book on a Japanese concept called Ikigai, which is what I also believe it to the core. And this thing of retirement actually comes from that belief because, Ikigai means that if you love doing something and it also helps you make a living, it also is aligned with your purpose in life, then keep doing it to the last day of your life.
Yeah.
So Ikigai is a great book, which I think every human on this planet should have on their shelves.
One anecdote in history that amazes you since you're a history buff.
There are various, but I think the one is that Mark Twain said that history doesn't repeat itself, but it often rhymes. And it happens.
Yeah. One financial belief you have changed your mind on.
I just gave you an example that trading doesn't lead to wealth creation. It's a zero-sum game.
Yeah.
And I closed my demat account and for long, I don't even have a demat account.
Oh, wow.
Yeah.
This will be the highlight of the conversation. Anyone from the financial industry that you are really in awe of?
Of course, among millions of fans of Warren Buffett, I'm also one of the fans because it is such a commonsensical and very inspiring story of patience and longevity. But apart from that, I think from that industry, Jamie Dimon is also of JP Morgan. I follow a lot because he's in a place like America where people don't really survive in the corporate world. He's been there with the longest time and continues to steer the institution with long-term values.
From newer generation entrepreneurs, given a chance, who will you like to hire for your team at CL?
While this is a hypothetical question, I know I can't do that, but just to answer something, somebody like say Ashish Mohapatra of business and Alok Vajpayee of Ixigo, because see, these are the generation of founders or a breed of founders who have built profitable, sustainable businesses. They are the ones who believe that what's the point of building market share if it will not lead to profits? And they build very sustainable businesses because of that, because in a true sense, it makes them less dependent on external stakeholders. So something like that.
That aligns with your philosophy.
You're able to build your business as per your vision.
One person who has inspired you the most in life and while building client associates.
So I think there are several, but since you asked one, I'll just take an excuse to add one more. And from the sporting world, so from our very own Mahendra Singh Dhoni, and second is Roger Federer. And I think what makes them attractive to me is patience. I think their focus and their patience and their ability to just stay focused on what they're supposed to do. Even if they have to execute their tasks surrounded by 100,000 people around them. And perhaps that's the reason they are who they are.
Yeah, how to be focused when the world is watching.
Well, the world is watching. You captioned it so very well.
Yeah. Thank you so much, Rohit. I really enjoyed our conversation.
Thank you for having me with you.
Thank you. Really appreciate you traveling all the way to our studio and recording this.
Thank you, Nancy.